The markets seemingly wake up with new conviction at the start of this week, having kind of sleepwalked through the previous one. And so the question we're going to ask ourselves here is, what is it that they're setting up to do, and where is it that they're steering? As we get seemingly a bit of a rethink about what everything that's appeared here over recent weeks means for investors really across the spectrum of major assets. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here, first and foremost, is take a look at how the markets behaved last week, what that might portend looking at the price action, and then consider, with this in mind, do we have a view on where we are heading next, and what are the catalysts that might power those moves? Now, as you might see here from the screen, the overall upshot to this conversation is whether the world can sustain U.S. economic strength. Because the story that we are going to find as we go through these markets, and then as we consider how to trade them, is that the U.S. economy appears to be diverging from the rest of the world, and in a positive direction. While this is, of course, good news for the U.S. economy, it is not necessarily the best news for markets, because it does seem to present a challenge for every country that isn't the US. So let's consider first the price action. Last week, a bit of a slowdown in the equities space, 0.8%. The rise in S&P 500, 0.2%. The rise in NASDAQ, that's of course a step down from the previous week's gains. The situation in the bond market relatively muted, nothing going very far in the long or the short end of the curve. But that's, of course, after 4 weeks of relentless rise in rates. And what we see in the prior week's numbers here being hinted, if you see the 3.4% rise the previous week in the 10-year and only a 0.9% rise in the 2-year, one of the quintessential features has been that rates have been going up faster at the long end versus the short end. More on that in just a moment. We see that crude oil has a significant leg down, 9.1%. That's ostensibly geopolitically related, as we started to get a sense that the escalation between the Iran-Israel theater, as it were. They are, of course, fighting directly, but there's been considerable concern that they might start. Israel is, with the backing of the U.S. for the most part, currently waging a war against Iran-backed proxies, Hamas and Hezbollah, and we've now had one episode of direct tit-for-tat missile strikes back in April between Israel and Iran. We are now waiting for another back and forth. We've had the opening volley from Iran. We're waiting for the Israeli response. Last week, there seemed to be a diminished concern that what Israel will do is hit nuclear or oil infrastructure. And if it contains itself to military targets, there was a sense that this would not be taken by Iran as escalation, and that we would essentially go back into our corners and watch therefrom. So that somewhat diminished geopolitical risk premium in crude oil really gave us the standout move, at least in percentage terms, last week. Gold continued to go higher, interestingly, and the US dollar continued to go higher as well in tandem, which is not typically what one ends up seeing. Usually gold, in that it yields nothing and is a kind of de facto alternative to paper currencies, tends to move lower when yields and the dollar are both up. And while yields didn't go up last week, they are barely changed at the highest levels they've been in months. Uh, and again, that's after 4 weeks of rally. So that gold continues to march higher in an environment where both interest rates are significantly higher and the dollar is significantly higher than they've been even just in 2 weeks is an interesting departure. And what it might signal is a kind of overarching narrative for what has been occurring here. Indeed, all of the price action that seems to be developing here comes at the same time that the odds for what the Fed is going to do at its meetings in November and December appear to be calcifying, while what happens thereafter is on the move. And here we see that since we really started to focus on the Fed actually triggering a decline in rates, when that became firmly in the near term for the markets here at the start of September, we see a rise in inflation expectations. These are break-even rates implied in bond markets. They're the difference between nominal and real rates. So when you take that difference, you end up with the inflation adjustment that you need to get from nominal to real and get the implication of what the bond market thinks inflation is going to do. And what we see here is as the Fed gears up to issue its jumbo-sized cut, and the markets become increasingly convinced that that's what's coming, inflation expectations march higher and have continued marching higher since. Against that backdrop, we get a steepening of the yield curve. In other words, interest rates downwind are expected to be higher and have been moving higher relative to interest rates in the near term, and gold has increased at the same time. Now, of course, what's interesting about this as well is that the US dollar has strengthened in parallel, because this means that, on the one hand, the Fed is looking at less scope to cut rates next year. On the other hand, it seems to imply that with the likelihood of a cut in November now in the 80+%, the likelihood of a cut in December in the approaching 80% reading, we have a situation where the Fed isn't going to turn from its course quickly. We end up with a situation where the market is invariably saying the Fed is perhaps going to make a mistake here. The Fed is going to be on autopilot and cut at its next two meetings when it perhaps might lay off the gas pedal, given recent dynamics. But since it won't, or at least it seems like it won't, what we'll have is both a more rapid reacceleration of inflation and an even greater likelihood that the Fed will be hamstrung next year in its ability to cut rates than might have been the case if it were to pause here and put a lid on what is going on. And it is perhaps like this that we might reconcile a stronger dollar and stronger gold and a steepening curve. It seems to all boil down to rising inflation expectations that the Fed is perhaps going to be a bit too sluggish to address. We see this show up in the cumulative outlook on Fed policy. We can see here we're still looking at significant easing, but the scope of cumulative rate cuts over the course of the rest of this year and next has meaningfully declined. We can see here it's declined not just thanks to what the Fed did here, taking out of 50 basis points right there from the total, with its cut, but thereafter. And it's really this shift that's really captured the market imagination. If we consider here where we were on the eve of the Fed's cut, we had 229 basis points baked in. Subtract the 50 that the Fed just did, and you're left with 179 basis points. Whereas the market now is priced for 132, amounting to nearly two cuts, 47 basis points, almost 50, that have factored out of next year's outlook. All of which suggests that we might well get 50 basis points further in November and December, but the outlook for next year will then be that much, about 50 basis points less dovish. What does all this mean? Well, we're going to find out this week whether the world economy can withstand that sort of an environment. And the first place that we are going to look is Canada. Now, Canada has a policy announcement this week. They are expected to deliver 50 basis points in rate cuts this go around. Note that the current rate at 4.25 compares with 3.5 essentially by year end, and gives us a difference of 75 basis points when there's only two meetings left. The one this week and in December. The Bank of Canada doesn't meet in November, which means that we're going to have three rate cut equivalents, 75 basis points, that's three 25 basis point cuts over two meetings. One of them then has to be double-sized, and it's this one that's expected to be double-sized. The markets assign about a 76-77% chance that we're going to get the 50 basis point cut this go around, and that's because Canada's economy has been a picture of divergence from its U.S. counterpart. We can see here that looking at the latest composite PMI data, as ever, of course, the 50 level is the center line. That's neither growth nor contraction. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what we find here is that Canada's economy has been not only contracting in recent months, but at an accelerating speed, which is an interesting perspective since nearly 80% of Canada's exports go to the U.S. So an important question here, as these two economies have diverged, whereas they're usually tied at the hip because of this very close commercial relationship, whether what's happening in Canada and the weakness there is any kind of indication of what may then happen in the US, because the divergence has only widened so far. We, of course, also see that the latest inflation numbers out of Canada saw the headline CPI, at least, dip back into an area below the midpoint of the target range, if only by a hair. And so, in so much as we have a target of 1 to 3% around inflation in Canada, this precipitous decline here, 1.6% is the latest reading, that seems to give the Bank of Canada all the ammunition that it needs to issue a big cut. The forecast update that will come in this announcement will be watched very closely, because it will ask the question, how is it that an economy so sensitive to the U.S. business cycle has so dramatically diverged? And what we're going to be looking at is whether a hot U.S. economy, where reflation is seemingly screaming that rates are going to be higher than markets have perhaps thought next year because of a reduced scope for cuts, how that is going to reflect on an adjacent economy, an immediately adjacent economy that's in dire straits and trying to cut rates as stimulus. And whether it's Canada that's foreshadowing what might be coming for the US, or whether it's the US that's foreshadowing what might become for Canada. How this divergence normalizes will be a very interesting question indeed. And in fact, that's the story that will continue as we get S&P Global PMI data updating us on broader global growth dynamics. Here we are going to get numbers for Australia, for Japan, for the Eurozone, the constituent economies, the major ones, Italy, Germany, France, and the UK, and of course the US. And perhaps the biggest thing to note here is the divergence between the two biggest of the bunch. The Eurozone is expected to see not only a second consecutive month of contraction, but the pace of contraction is expected to hold generally unchanged. So we're looking at maybe a little bit of a pickup, but nevertheless, dire straits as compared with the US, where, if we can see here, we're expected to see growth remain on pace. What's interesting here as we consider this is that overall global PMI has in fact been trending lower since peaking in May. We can see here the global service sector is really what's the catalyst here, and a pickup in manufacturing that has fizzled, where global manufacturing is once again contracting at the fastest pace we've seen in over a year. That's not helping either, clearly. That, of course, raises an important question. If we look at the way that global growth is constructed, about a quarter is the US, 15% the Eurozone, 17% China, 42% the rest of the world. This is data as of 2023 from the World Bank. And so we can see here that of a commanding share of global GDP, 58%, is comprised of just three major economies, of which the US is the biggest piece. And if we consider how much the rest of these economies are dependent for demand on the former three, in that they're largely vendors to these three, the impact of the big three is in fact even larger. And what we seem to be looking at is increasing disparity between what those three engines are doing. The Eurozone, as we can see here, is in contraction mode. The situation in China is standstill. Ever since we saw the reopening from COVID here and a bit of a flash in the pan bounce as the economy reopened, we've settled into anemic standstill. And all of the recent announcements of stimulus don't seem to be fueling any optimism for a change. Meanwhile, in the US, we're looking at growth that hit a 12-month high back in May, that's relative to May of 2023 right here, and has since held those levels. What's more, US resilience appears to be relatively localized, because if we look at the way emerging markets have performed, this is, of course, the lion's share of what lives inside this rest of world piece of the pie, at least as far as number of economies. Here we see that things have actually cooled, and that in particular, the service sector is at its slowest since about, at this point, over a year ago, and manufacturing is essentially stopped right on the 50 level. And so the question then becomes, well, is the US really a lone standout with the rest? China is at standstill, the Eurozone is in contraction mode, and the emerging markets that are vendors to the whole of the bunch are weak as well, seemingly suggesting the US stands alone. We get that sort of a sense when we look at surprise indexes from Citigroup, where we are looking at the way that economic data performs relative to forecasts. Here's the zero line dividing upside data surprises, downside data surprises. Note where we are for the global index, where we're narrowly tending to surprise on the downside, but not because of the US, mainly because of what's going on in other major economies. And the Eurozone is a potent signal here. It is well below zero, but so are emerging markets. They too are set to favor disappointment on economic data, and weakness in China is almost certainly a big part of that story. But the US has pointedly diverged and actually seems to be accelerating rather than decelerating, which of course further speaks to this reflation narrative and signals more of this. And of course, more of this means higher interest rates, less scope for the Fed to cut, and perhaps a stronger US dollar. Indeed, this becomes an issue for nearly everyone, and perhaps an even louder one than usually, since we have a summit of the BRICS economies this week where Russia really wants to talk about an alternative payment settlement system that doesn't use the US dollar. They, of course, have a high interest in that since sanctions have locked them out, but they've inspired others into a conversation saying, well, if the US is willing to weaponize the dollar against us, maybe they'll weaponize it against you. And so this BRICS summit will take up the question this week. But what we find in reality is that the dollar is so overwhelmingly dominant as a share of global payments that the volumes being done by the BRICS collectively are a pittance in relative terms. And the close proximity of China tells us that most of this is China, with the other economies, Brazil, India, and South Africa, barely on the radar. All of which makes the current situation an important one to consider. If the US is in fact standing alone and diverging, and that will mean higher rates in the US that the Fed will have to adopt, at least relative to expectations, that means a higher borrowing cost on dollars relative to expectations. And the dollar is, whatever the BRICS may want to say, the overwhelmingly dominant settlement currency for global commerce by a long, long, long mile. Which means that when the Fed is less dovish, borrowing costs are relatively higher on global commerce writ large for everyone. But if everyone is diverging toward weakness, they can ill afford those higher rates, making for a precarious situation for the global economy and a very interesting open question for stock markets. Wondering, can they keep powering higher if the dollar and yield continue to shift to US outperformance? But what that then means is a hobbling of an already precarious economic situation elsewhere in the world. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. I'm on with Chris for Futures Power Hour Mondays, that's today, and again on Fridays. On with Victor Jones for The Price of Truth on Wednesdays. On with Victor and Tom for First Call Sundays. Writing for the News and Insights portion of tastylive.com. And commenting on the platform formerly known as Twitter, at Ilya Spivak. If you're watching on YouTube, like and subscribe. Thanks very much for watching. Macro Money's back tomorrow.